no longer in complete control, hence causing the wide swings in both directions. Now again, there are the two subtypes of wide divergence, which is 1. When the divergence occurs at or inside of the overbought or oversold region. Notice how it's clearly occurring in the oversold region. Or 2. When the divergence occurs close to the overbought or oversold region. Notice how it's close but not touching. So, moving on to the second type of divergence, which is tight divergence. Which is exactly that. It's divergence where the swings are tight or very close together. Here's your downtrend. We had our divergence before the reversal occurred. But notice how the swings are very tight, hence the name tight divergence. Now, in this example of tight divergence, you can still see the swings of price, but sometimes with tight divergence, it isn't as easy to see, especially to the untrained eye. So here's an example. This here is tight divergence. At first glance, it might not look like it, but this is what price is doing. Run, small pullback, run. Meaning this here is your lower low, while the RSI indicator made a higher low, which is clear tight divergence. Again, this might have been harder to spot for some traders. So here's an easy trick. At the top of your charts, if you click this button right here, it will turn your chart into a line chart. So let's do exactly that. Let's turn this exact chart into a line chart. Now, notice how you can clearly see price making the lower low and the RSI making a higher low, showing a clear tight divergence. And then once you identify this on the line chart, jump back to candlesticks. So here's another example. This here is where your divergence occurred. And here is the movement that price made. Run, pull back, run. Price made a higher high, while the RSI made a lower high, hence your divergence. Again, let's switch to the line chart to show this more clear. Here you can now clearly see the swings of price. Higher high, lower high, clear divergence. And again, when you're done, just switch back to your candlesticks. So when we get to the strategies section, you'll understand why tight divergence is just as important as wide divergence. So again, we have the two subtypes of tight divergence, which is 1. When the divergence occurs at or inside of the overbought or oversold region. This is clearly occurring in the region. Or 2. When the divergence occurs close to the overbought or oversold region. Notice how it's close but not touching. So let's put both wide divergence and tight divergence on one chart as a quick recap. Wide divergence, reversal. Wide divergence, reversal. Wide divergence, reversal. And then tight divergence here, reversal. So as a quick recap, here is our divergence hierarchy. Now all divergence is good, but just use this hierarchy to rank the quality of the divergence and the trade you are looking at. So let's keep building on this and move on to the next section, which is combining divergence with confirmation. So, divergence combined with confirmation means you look for price action after the divergence occurs to confirm that the reversal is real and not a fake out. So let's break this down. This is a clear moving uptrend as price is making higher highs and higher lows. Run, pull back, run, pull back, run. You then spot this clear wide divergence formation. Now, this is what we call divergence unconfirmed because it can start as a divergence, pull back slightly, and then still continue on. And then you would have been faked out and took a loss. Don't forget that you are trading counter trend. So just an RSI divergence alone isn't enough because that would be guessing based off an indicator. So what you need to do is combine RSI divergence with price action after it occurs in order to confirm that the reversal is real. Now, there are many price action strategies we use in combination with divergence, but to keep things simple for this video, one great way to do this is to apply a dynamic trend line onto the immediate trend. Then, You wait for the break through the trend line to occur, which then confirms the divergence and confirms the reversal. As a bonus, this breakdown also made a lower low. And at this point is when you go to the lower time frames and start looking for short entries. So let's show this again. This is a clear moving downtrend, as price is making lower highs and lower lows. You then spotted your clear Y divergence. This again is your divergence unconfirmed. So what you do is you put a trend line onto the immediate trend and wait for a break to occur. As price came up, there would still be no trade for us, as price failed to break the trend line. It's not until you finally had your break here that we would consider long trade entries. So you are probably thinking, why not just jump right into a trade at the second head of divergence here? Well, you don't know this move would occur, meaning price could have pulled back slightly and then continued down. Again, you are going counter trend, and counter trend trades need extra confirmation as they hold more risk. So this works the same with stocks. Here's the Disney stock. You again had your moving uptrend as price was making higher highs and higher lows. You had your clear Y divergence. You then had your trend line applied. And once you had price break through the trend line, the divergence is confirmed, which presented a possible short trade opportunity. So let's go through the same concept, but with tight divergence. Here's your clear moving downtrend. You then spotted your tight divergence. So let's switch this chart to a line chart to show this more clearly. Again, as you can clearly see, higher low on the RSI, lower low on price, which is divergence. So jumping back to candlesticks. After this divergence was identified, we put a trend line over the immediate trend, and once price broke through is when the divergence is confirmed, which presented possible long trade opportunities. So this works the same with stocks. Here's the Pinterest stock, clear moving downtrend. You then spotted your tight divergence. Let's again switch to the line chart to show this more clearly. Again, as you can clearly see, higher low on the RSI and lower low on price, which is divergence. So back to candlesticks. So again, we put a trend line over the immediate trend, and once price broke through is when the divergence is confirmed, which presented possible long trade opportunities. Now, here's a great example as to why you need confirmation and why to not enter trades solely based off of divergences. Here's the Walmart stock. Price was clearly in an uptrend as you had your run, pullback, run, pullback. Now, you would have then spotted this great wide divergence here, and you thought to yourself, this is a great short opportunity. What you are forgetting is that this is a very strong uptrend. As you should already know by now, you would only start considering short entries after the divergence if you had the trendline break, a break through the key support, and price making a lower low. Without that, the divergence was unconfirmed and there was no trade. To make matters worse, a lot of traders went long at this access point here, where the trend line and key support level both lined up perfectly. This is actually a concept we discuss with our members about knowing where price is coming from, but we will cover that in a future video. So divergence combined with confirmation is only the base concept. We do not enter trades simply off of these two factors. Now let's take this up a notch and move on to the actual strategies section of this video. In this section, we will be building on all concepts we have discussed in past videos. So if there's something you don't understand, make sure to go back and watch all our older videos after you watch this one. So let's get into it. So the foundation of this strategy is combining divergences with key levels or areas of confluence for high quality trade entries. As a quick recap, key levels or areas of confluence